Good afternoon, everyone, and welcome to another Tax Tuesday. I am Clark Boyd, and today with me is Kathy Stump. Today we're going to be talking about something that we see every single year, investors making good real estate decisions, but accidentally poor tax decisions. So real estate can create really massive tax advantages or unexpected tax surprises, and the difference usually comes down to planning. Our goal today isn't to turn you into a tax expert, it's really to help you think like an owner and an investor, not just a filer. So by the end of today, hopefully you'll understand how rental properties are taxed, why some investors show losses while building wealth, but also how you can make decisions that impact how the taxes are impacted later down the road, whether you sell or exit it some other way. Think of this as your real estate tax playbook, between ownership, optimization, and exit. So we're going to start with a little introduction on who we are. Molen & Associates is a tax and accounting firm. We've been doing business since 1980. We specialize in real estate investors, real estate agents, but also small business owners. Whether you're self-employed, contractor, or have a true small business with employees, we can definitely help you there. So starting with the foundation, this is what most people like to skip, but it's probably one of the most important things when it comes to running a good real estate business. Your real estate is a business activity. You have to treat it like one. So number one rule, make sure you have a dedicated business bank account separate from your personal bank account. That doesn't mean if you need money to fund your business, you can pull it from your personal, or if you need to take money out of the business, you can take it from the business, put it into personal. But when you're getting rent in or you're paying for bills, make sure it's coming out of your business bank account. It really should be specific to that business purpose. Take it even a step further. If you have multiple properties, sometimes it's beneficial to have a dedicated bank account per property. So if you're not super organized and you want to let the system run itself, that is the easiest way to do it. But the biggest thing is you do not want to commingle business versus personal funds. As far as proper documentation goes, receipts, contracts, and mileage logs are huge. Those are the three things we see that are very rarely collected. So receipts are always good. In Texas, heat will kind of make your receipts go bad. So I recommend taking a picture of it, putting it in Dropbox, Google Drive, even writing on it the who, what, when, where, why, and how on there. So if you're having a business meal, who did you eat with and what did you talk about? You just take a picture of that, upload it to your folder, and then you're set. You hopefully never have to come back to it ever again. But if you do, if you're in the case of an audit, you got it there ready. Contracts are really big. If you're a landlord leasing something to a tenant, you want to have a contract not just for liability purposes, but possibly for tax circumstances. If you're a wholesaler, if you're doing lots of different things, need contracts. So contracts are very important to keep. You want to keep those for as long as you would keep your tax records. And mileage logs. Mileage can really add up, especially if you've got multiple properties and you're traveling to different locations. It's 70 cents a mile as a tax deduction. So don't lose out on those tax deductions. Kathy, anything to add on this one? And that foundation with the bookkeeping, clean record keeping?
I think most everyone is familiar with all the different apps that's out there now. There's a lot of them that will help you track your mileage rather than just tediously writing it down somewhere and keeping up with it. They work really simply. One that we see a lot of our clients use is called MileIQ. And it produces a really nice report for you at the end of the year to show your documentation of your mileage.
Perfect. So before we jump into all the tax strategies, things like that, we want to cover how rentals and how real estate really is taxed. So not all real estate is taxed the same. You may have heard active versus passive income. That is a big thing with real estate. The IRS will actually look at how the property is used. So if you're doing a short-term rental versus a long-term rental, there's different tax consequences. If you are fixing and flipping, there's different tax consequences. So all of those are probably the three most common categories. Kathy, can you think of any others, or does that sum it up?
That pretty much sums it up.
Okay. So starting with fix and flip. So if you're buying, renovating, and then selling for a profit, this is an active business activity. So it's less like buy and hold, you're renting out real estate. It's more like a true business rather than when most people think of real estate, but it's taxed as ordinary income. So this can be often subject to self-employment income if you're if you're doing it as a 1040 Schedule C or a partnership. So that's something to be aware of. This is not passive investing. You are involved in the day-to-day. So just be aware that it's not capital gains. You're not buying it here, selling it here for long-term capital gains. This is an active business activity. For long-term rentals, this is where you're buying an asset and you're holding it for long-term. Usually long-term rentals, Kathy, when is the cutoff there? Is it 30 days? Is that minimum cutoff?
Yes, 30 days.
Okay. So in the real estate world, if you're saying even midterm rentals, if you're doing, for example, rentals to traveling nurses, a lot of times those are 3 or 4 month contracts. That would still be considered a long-term rental. This is generally a passive activity. You can depreciate against that income to create some tax advantages. Your wealth can grow even if your taxable income stays very low. So if you've got rent coming in, let's say it's $2,000 a month of rent, but your mortgage is, let's call it $1,500. Maybe your cash flow is $500 per month. Your depreciation over the long term may may offset that income. So your taxable income could be very close to zero, but you could be taking home money. So long-term rentals are a great way to kind of build that wealth very slowly. Whereas fix and flip, it's more short term, but maybe not quite as tax advantaged because you're paying a higher income tax rate. Short-term rentals, so think VRBO, Airbnb, even if you do kind of self-rental. So this is anything less than 30 days. A lot of times it's vacation homes. It doesn't have to be. These are determined, the tax treatment is determined by the stay length and the participation level. So this one is usually, it can be more of an active activity. If you are managing it, it's a lot more hands-on. Think of it more of almost like a hotel. You're running a hotel rather than a long-term rental with just an agreement in place. So there's a lot of tax planning opportunities and quite a bit of complexity if you want to do this right. Anything you want to add on those ones, Kathy?
I think it's really important on short-term rentals to make sure that you're documenting the services that you're providing. If you have a property manager, it makes it a little bit harder to prove that you're actually running the business. If the property manager is doing your contracts, managing your website, all of those kind of things. It also makes a big difference if you're providing outside services in addition to the Airbnb, like almost like concierge level services that can show that you're doing more toward the rental than just handing it over to a property manager.
Mm-hmm. So really, like I said, it's kind of a split between owning real estate and running a business. It's kind of a gray area. So in that gray area, it creates opportunity, but also some complexity. So if you want to do it, there's some great tax strategies that come with it, but you have to be willing to do it the right way. So a couple other notes before we keep going to those strategies. So here's some terms that we want to make sure we cover. So income and expenses, every business, you should have some sort of income. If you're fixing and flipping, your income is what you're selling the property for. Your expenses are the work you're putting into it. Whether it's labor, cost of goods sold, whatever you're putting in the property. For a long-term rental, it's just rent. Your expenses are, maybe it's your mortgage, maybe it is utilities, yard maintenance. All those things are considered expenses. Expenses reduce your taxable income. Depreciation is an expense, but it's more of a paper loss. So you're not actually spending money to get that expense. Depreciation is you take the value of the building and you spread it out over 27 and a half years or 39 residential versus commercial. Appreciation is when your asset grows in value without, sometimes you don't have to put any money into it. So if you buy a house right now for $300,000 and in 5 years it's worth a little bit more, that value that it increased is the appreciation. Another important concept here is if you buy a house and you refinance it, you may be able to take money out of there. So let's say you bought it at, let's call 500,000 and you sold it, or you're going to refinance it at 750. There's some appreciation there that you have to play with. So if you refinance, the bank is likely willing to give you a larger loan than we originally had. So you may be able to pull out $200,000, $300,000 worth of money, and you don't have to pay taxes on that. But it's not taxable income. Capital gains is really where, for long-term real estate, is where most of your money will come from a tax standpoint. So if you sell, that difference between what your purchase price is and your sales price, you would pay capital gains on that increase. But if you've been depreciating it, whether it's 27.5 years or 39 years as a rental property, you need to make sure you're recapturing that depreciation. So as we mentioned, you didn't spend money to get the depreciation expense, so you would have to recapture it upon sale. The only difference comes into play with your primary residence exclusion. So if you're single, if you bought your house at 500 and you sold it at 600, you don't pay taxes. So you have a $250,000 gain exclusion for single or $500,000 for married. So that can be pretty beneficial. Some of the rules there, you have to be there 2 of the last 5 years. You can't claim another property as your personal property or your primary residence. So there's hopefully some strategy there to make sure you do it the right way. Kathy, any other thoughts on those kind of basic definitions?
No, I think you covered it.
Awesome. So here, this goes over more into depreciation. We covered most of this. So as I mentioned, depreciation for residential is 27.5 years, commercial is 39. An important note, you do not depreciate land. So land will stay there forever. It's the building, the fixtures, the assets that you put onto the land that you can depreciate. When you're talking repairs versus improvements, these are very important, especially when you're considering doing your own bookkeeping. If you're not hiring a bookkeeper, you need to know the difference. So if you are making a repair, so let's call it if it's $500 or less, or $2,000 or less, whatever your threshold is. If you're fixing a light bulb, you're fixing a light switch, those are just repairs. But if you're doing improvements, maybe you're putting a new roof on, you're putting a new floor, you're doing new sheetrock. Those are not just simple repairs. That's going to be a little bit more costly, and it should be capitalized and depreciated over time. You would not count it as an expense in that current year. The one caveat there is if you want to introduce bonus depreciation or Section 179, bonus depreciation is allowed for a qualifying component to accelerate that depreciation from 27.5 years or 39 years into a much shorter period of time. So right now it's at 100% for bonus depreciation. For real estate, you would have to do a cost segregation study to do that. So it could be very beneficial if you own multiple properties and you're looking to offset some of your income. But that's kind of a quick summary on depreciation. Active versus passive losses. Kathy, do you want to go over this one?
Sure. Active versus passive most often applies to rental property. Basically, the IRS looks at that like you're not really, it's not like you're going to a quote unquote job every day. Your rental property that you've purchased is producing that income. There are ways around it. They're pretty strict though. Losses can be limited at higher incomes. There is an active participation allowance, but it phases out at probably between $100,000 and $150,000. You would gradually at 150, you would not be able to take the 25,000 of allowance for active participation loss. But the other issue after that is, making sure that you document your time. What are you actually doing? If you make trips once a week to the property to check on it, or you make a trip, some places use like low occupancy periods in Airbnbs to spend a lot of time, refurbishing it, getting it ready for the next season if you've got a seasonal property. It's just really important to keep track of what you're doing so that if the IRS does ever question it, you can prove that you did have that active participation going on. You don't lose your losses, though. Just keep in mind that those losses would carry forward until you sold the property, and they would be what they call kind of released at that time. When you sell the property, they would count against your any gain that you had recognized on the sale of the property. And that's the suspended losses. We're saying they're not lost. They carry forward indefinitely. There's no time frame on them. You don't end up losing them just because you didn't get to take them in that first or second or fifth year. Real estate professional status is the highest level of participation, and it's more or less, if you look at those requirements, 750 plus hours in a year. and more than 50% of your work time. So basically, it's your job. That's what you do day in and day out. It's not a part-time activity. And documentation is even more critical of this, because whatever losses that are generated with you have this status are allowed against other income. So you just have to make really, really sure that you're keeping a strong record of where you were going, how many hours you spent, what the purpose of any trips were, anything like that. Documentation, you can't really stress too much to be able to utilize this status.
So quick question here. Let's say I am married, so I have a full-time job. I really can't qualify as a real estate professional. If my spouse became a real estate professional and she met both of these requirements, is that something that you could still claim that active real estate professional status with?
Yes, you could, as long as your spouse is meeting the criteria and that's more or less their full-time job. It would count against your combined income.
Perfect.
Losses would.
So the next section here, and these will all kind of come together. So we've talked about loss carry forwards, active versus passive losses, bonus depreciation. Cost segregation is kind of that missing pin that ties all of it together. So a lot of people are not real estate professionals, but if you are, it could be a good way to get that active, turn it into active income so you can offset your W-2 income or other sources of income and not just carry it forward. So the cost segregation, so you normally have rental income is passive. If you do a cost segregation, basically what happens is you are doing those different services and it turns it, you break it down into all the different, breaks it down into the different structures. So like I said, the walls have a different value, the ceiling, the lights, the floor, everything has a different variable life. So whether it's 3 years, 5 years, 10 years, 100 years, whatever it may be. So it's a way that you can accelerate those deductions into a near term. So rather than being 39 years for a commercial property, it can go down to 1 year, 2 years, 3 years. You get a lot more deductions up front. So it's a good way to improve cash flow, especially if you are able to offset your active W-2 income. It's based on the year that it is put into service, not the year that the study was done. So that can be really helpful. So here's an example. So if you normally take 39 or 27 and a half years, you split it into the building structure, tangible property, leasehold improvements, land improvements. It takes it in these different buckets. And these 3 buckets are what you can bonus depreciate. So if we were to take that and we were to do the same thing with a $5 million commercial building, the normal straight line depreciation would be $338,000 per year. So it sounds like a lot, but when you compare it to $5 million, it is not all that much. So a cost segregation would break it down into these different buckets. And then from there, we'd bonus depreciate these 3 buckets. At that point, your new bonus depreciation is $2 million. So you think about if you're, let's call you in a 34% tax bracket, you're taking roughly a third of this home instead of paying it in taxes. That can be a huge, huge value add. You can do this on a single family home as long as it's used for business purposes. It does not have to be commercial property. So some of these phase outs with the One Big Beautiful Bill, with the Tax Cuts and Jobs Act, it was set to expire. So starting in 2017 through 2022, we are at 100%, going down to 80, then 60, then 40. So on January 19th was the last day of 40% bonus depreciation. With Inauguration Day, with the One Big Beautiful Bill, it then jumped up to 100% bonus depreciation. So from now on, we get that 100%. As I mentioned, it's when the building is built, not when it's studied, that determines the bonus depreciation rate. So just make sure you know which percentage would apply for you. Kathy, do you want to take short-term versus long-term?
Yes. Short-term rentals are just kind of what they sound like they would be. Average stay, less than 7 days, possible active treatment if you're doing all the, the management of it and running it. 7 to 30 days, there's additional rules. You have to prove that you're providing those kind of concierge level services. You're doing more than just signing a contract and giving them a key. You're providing, just additional services to make it more like a kind of a fancy hotel. Material participation does matter, all those things. And like I said, we can't stress documentation too much. Just going back and saying that, oh, I spent about 2 days a week there, or I spent, 10 hours a week. If you are audited on this, the IRS is going to want to see some kind of a log of your time and showing what you were doing, that you went to the property to do maintenance, you went to an office supply store to buy supplies, you went to, if you're providing concierge level services, you're going to, places to make little baskets of goodies to put in the rooms. Just anything to show what it is that you're actually doing so that you can prove that material participation. And here's entity structure discussions, and this is basically how your property is held. S corporations have many useful items, but they're not generally beneficial for rentals. LLCs do provide liability protection. They don't necessarily make an automatic tax savings of any sort, but it does keep it kind of makes it its own little entity so that you have just a little bit of kind of insulation from your personal liability. It also gives you kind of a just a built-in structure to keep your records separate. You can say, well, okay, I've got this bank account for this LLC, and I've got this bank account for this LLC, and I've got these properties in each one. It's not automatic tax savings, though, having the LLC. The tax savings would only be, your income minus your expenses is going to drive your income from the property. It's basically the same as not having a company for it. It's just a little bit more of kind of a little bit of liability protection.
And one of the that's probably one of the biggest misconceptions I always get with new clients coming in. They're like, oh, I formed an LLC. What new deductions do I unlock? It doesn't quite work that way. An LLC it's a state filing. It's not a federal filing. The IRS doesn't care. It's taxed the exact same way. And for example, an S corp, a lot of times people don't realize by putting their property into an S corporation, as soon as you're to transfer it out, that's a taxable event. If you transfer it from the business to your personal. So we've seen a lot of people get hit with taxes unintentionally by putting a property into an S corporation when it should have just stayed in an LLC. A partnership does not have that same tax treatment in all circumstances. So yeah, choosing the right type of entity is super helpful. As far as some deductible expense ideas, we talked about mileage. Make sure make sure you have it documented. Use MileIQ, use Herb, whatever app you want to use. Just have something to make it easier on your life. If you scan that QR code, we have an expense checklist specifically for rental real estate. This won't cover as much for the fix and flip side, but you can do short-term rental, long-term rental, at least get some ideas for your expenses there. Some common ones are professional fees, whether it's our services, the tax and accounting, legal fees, consulting, advertising. If you're listing things, your ads, your photography, those are some commonly missed ones because it's not part of your normal day-to-day. Obviously, if you're doing repairs, maintenance, things like that, that's also deductible. Jumping into kind of the exit phase of this. This is, I think, one of the coolest things about real estate is tracking your step-up basis. For estate planning, your step-up basis resets at death. So let's say you buy a property at $500,000, you hold it for 30 years, your mortgage has been paid off, you had someone paying your rent, so they're essentially paying your mortgage for you. It's appreciated in value. Let's say it's now worth $1 million. So you have $500,000 worth of gains at this point in appreciation that technically if you sold it, you'd owe a lot of money on that for taxes. But if you die and you pass it on to your heirs get a step-up basis. Their new basis is $1 million. They don't have to pay the taxes on that growth. So it allows you to remove the excess gain. So it's really cool there for the step-up basis. If you're looking to exit in other ways before you pass away, because not all the time do you want to hold on to a property for a million years until you die, you can sell it. So in the case of a sales event, you would owe the capital gains on that difference. 1031 exchange is a way, it's called a like-kind exchange. So if you're doing real estate for real estate, you can do one property to one property, one to two. The numbers aren't as important as long as you're doing like-kind, but it's a way that you can roll over that basis from one property to the next. You can put more money in, take money out. There's different variations there, but just make sure you work with a qualified intermediary there. We've seen way too many people do this wrong, where they think they can do a 1031 themselves. The devil is in the details. You want to have it documented. You want to make sure you're following the steps, doing it timely. If you miss this by one day, you're no longer qualified to do a 1031 exchange. So there's a lot of details there. For installment sale, this is a great way if you want to spread your gains and taxes out over a few years. Your exit options, like I said, you can hold long-term and you just never sell. Sometimes you have a really good property and you just want to get some money out for a different business venture. At that point, maybe you don't sell it. Maybe you just refinance. Maybe it's $200,000 or $300,000. You can cash out, refi, take that money, and that is not a taxable event, as I mentioned. You can take that money, put it into a different business venture, make some money with that over there, or maybe you want to live on it, whatever it is. That's a great way to use real estate to not create a taxable event. And if it's still cash flowing with rent, then you're golden. So we're going to go through a couple of those here. Kathy, do you want to take installment sales?
Yes, installment sales is where you sell a piece of property to another entity or to an individual, and basically you become the bank. You kind of upfront them the money to buy the property, and they give you the payment over time, just like they were paying to the bank. The nice thing about this is that you do get to allocate your gain over however many years the installment sale is. Just for round numbers example, say you had $100,000 gain on your sale and you installment saled it for 10 years. And you would only recognize $10,000 a year of the gain. You wouldn't have to recognize the whole gain up front. There is some cash flow flexibility in that, of course. You have to make sure that if you've got, doesn't work quite as well if you already have another loan on the property, if you have to pay that off before you can personally finance it. The other thing that you have to be kind of conscious of is that you are kind of a bank, and if the person defaults, you could stand to lose some of your money. And then also the depreciation recapture is usually up front. So if you've depreciated it for several years and part of that gain is going to be depreciation recapture, then you would have less benefit of it over the life of the refi. (1031) exchanges are it's not as much of a cash flow issue, but it is a deferral of gain. It's not just, okay, I did 1031 and I never have to pay a gain on it. It's not like a step up in basis. If you've got $100,000 gain on a piece of property and you do a 1031, that $100,000 of gain is still there. It's just transferred over to another property. So down the road, at some point, if you exit out of that property in some ways, that deferred gain would also be taxable at that point. You can't stress enough the qualified intermediary. You really can't do this on your own. You have to have somebody to, sign off on it. If you have to show who it was that actually did the actual legal side of the transaction. Again, deferral, not elimination.
Yeah. So this is a deferral of capital gains, but also that depreciation recapture. So I'd say common times we see this, or if people, maybe they start in single family, they got 4 or 5 single family houses, they've held them for, let's call it 10 years. The mortgage, it's got a good amount paid down, but it's still not fully paid off. They've been taking depreciation. So they actually have quite a bit of gains built into this because the property's appreciated. They've got a lot of cash tied up in it as well because they've held on to the properties for a while. So let's say it's 5 single family rentals, maybe each one has $200,000 cashed into it. You can take, that's now $1 million of your money. You can roll that into a larger commercial property, and now you've got a $5 million business or $5 million asset because you took that $1 million, that's your down payment, you've got a loan for $4 million. So you can turn it into a better cash flowing real estate. Sometimes you just want to simplify headaches. People move from single family to retail or commercial, some other different class of real estate. But it's a good way to defer it, keep that real estate strategy going without having to pull all your money out, maybe more leverage. So 1031 is a great idea. Just going through a quick summary here as we talked about the ownership phase, optimization phase, and exit phase. So in your real estate journey, you may be in one of those three. Sometimes you're in multiple. Maybe you're still going through and figuring out that ownership phase and you're trying to get through the optimization. Just make sure that you don't forget about that ownership phase, because no matter where you're at, those three, the bookkeeping, deductions, and depreciation, are always important to remember. Some of the optimization, you may choose to do it or not to do it. That is okay. When we do your taxes for you, we'll make sure you're at least being compliant, you're taking the deductions that you can, and we'll educate you on which strategies should or should not apply. And then the exit phase, it really is up to your personal plan. Whatever you want to do with the property, with those funds, with your retirement strategy, it all comes down to your personal preferences. So that is our content for this week. Thank you guys for listening. We're going to save a few minutes for a quick Q&A. So in that top section of the bottom section of the toolbar, there'll be a question mark and a chat bubble. Feel free to put any questions there, and I'll read them out. Okay, our first question here. Can I deduct losses if my income is too high?
Losses can become suspended losses due to passive activity limits. So you can't always deduct them in the year that you, if you're over the income limits, you're not a reps qualified person, you might not be able to deduct them in the current year, but they're not lost. You can carry them forward and, deduct them in a later year. If you become more profitable in a later year, they can reduce that income. Or if you carry forward with many years of losses due to high depreciation or high interest rates, then you can deduct them at the end when you sell it. They're never lost. It's just a matter of when you take them.
So if I purchased next question here, if I purchased a property in the past, let's call it 5 years ago, just for the sake of an example, what happens if I never claimed depreciation?
Well, that's not good. You, number one, you're missing out on a deduction year by year, and it's harder to generate real estate losses without claiming depreciation. It can be done on smaller properties, but you're missing out on the tax advantages of the year by year by not taking it. But then there's also a double whammy on that. If you sell the property down the road, the IRS says that it's depreciation allowed or allowable. So if you were allowed to take depreciation, which you would have been as a real estate investor or property owner, even if you didn't take it, they're going to make you recapture it as if you did. So it would cost you both the tax savings along the way, plus you also get the whammy at the end when you sell it, that it would have to be recaptured.
Perfect. Is there any way to correct that if you've missed out? Is there a form you can file, or do you have to go back and amend?
There is a form that you can file to go back and correct for depreciation. It's called a 3115. And basically what it does is allows you to just say you'd missed it for 5 years. It allows you to claim that 5 years of depreciation on one tax return and carry it forward so that you don't have to go back and amend all the 5 years that were missed. Then that depreciation is captured in that 1 year and carries forward. And if it exceeds the income to the point that you can't deduct it, it's still, you can't deduct it against current income, it still would carry forward.
So you're not just completely out of luck. There is a way to correct it, but the best situation is to not do that in the first place.
Yeah.
Awesome. Okay, and last, I guess 2 more questions here. What qualifies as material participation when it comes to real estate?
Material participation is the highest level of participation. It basically is the participation level that it's your full-time job. It's got the 750 hours per year requirement, plus the requirement that it's at least 50% of your working time. So if you have a full-time job, that's something else. It's very hard to qualify for that, because basically you'd have to be working 2 full-time jobs to be able to do that. So that is the highest level. And to be able to document that, again, we talked about it before, but it is super important to have detailed records of what you were doing, the days that you were doing them, the different roles that you play in the company. If you're doing advertising, if you're doing maintenance yourself, anything that you're doing the contracts, anything that you're doing, just make sure that you're doing really, really good documentation of that.
Perfect. And last question today before we wrap up, what do you see that triggers an audit most often?
There's not really a trigger for audits. The IRS can randomly select you for an audit. Number one, it doesn't always have to be something that you did, but they do look at sustained losses over years. Like if you've got a loss every single year and it's growing, and it just doesn't seem logical. If you've got high repairs every year, are they really repairs, or are they material items of value to the house? And super high mileage. If you've got 1 or 2 rentals and you're showing that you're driving 50,000 miles a year, anything like that that doesn't seem logical can be a trigger for an audit.
Perfect. Thank you. Well, thank you guys for joining us today for this week's Tax Tuesday. We hope you've gotten some clarity around how real estate is taxed, as well as how planning ahead can be significantly impactful for your long-term results. If you have any other questions, feel free to shoot us an email or call us at 281-440-6279. We're happy to help. Also, don't forget about next Tuesday's Tax Tuesday. It'll be every Tuesday during tax season, and then after that, we'll continue on a monthly basis. So we will help you as business owners and investors make smarter tax decisions through proactive planning. Thank you guys. Have a great day.
Thank you. Have a nice day.